Hello, everyone, and welcome to the Home Ownership Rally Education course. This is for not just first-time home buyers, but anybody that is looking to purchase a home. First off, what I'm going to tell you here is what you're going to get out of this. And basically, that's just everything you need to know or a crash course in buying a home. I'm going to give you some tips, some special things to look out for that can help save you money and time and headache in the future. And with that, and after a short introduction here, we'll get right into it. My name is Stephen Michaels. I work with Guild Mortgage here in Wichita, Kansas. And I have been in the finance world or realm for about 25 years. I've been doing about 18 years of that in home lending. So I won't go on with a long resume. We're just going to jump into this. Please comment or ask questions. And at the end, I will leave a link to how to get a hold of me. So if you want to reach out or you need a special like one-on-one sit down or meeting, I'm happy to do that. So right off the bat here, we jump into bad credit history. So obviously, credit is going to be something that comes up quite a bit. Sometimes people have great credit, sometimes they have terrible credit, and there's everything in between. What I'd like to point out on this versus going through every single, problem is that everybody's situation is unique. Okay. It really takes a one-on-one consult, which by the way, we can do via via a soft pull, meaning what's the difference between a soft pull and a hard pull? A soft pull, basically, we can pull your credit. It doesn't alert lenders. It doesn't other lenders. So that's when, we pull a credit hard, we pull it, and then you have about 30 different people calling you, right? So it eliminates that. One, two, it does not affect your credit score. So what that allows us to do is to get a snapshot of what you have going on, okay? And then from there, I can have a more intelligent and meaningful conversation with you about it. Now, I'm going to get into other things further into this about credit. So we're just going to keep moving on. But just know that that's the first step is just getting in front of a professional that can help you and tell you, hey, even if you have good credit, look, I can run a report that says if you pay this card down $200 a month or $200, let's say you owe $500 on it and you pay down 200, maybe your score jumps up 20 points and you go from a 700 to a 720, which puts you into a new tier and we'll be able to get you a better interest rate. So everybody's situation is unique. It's not always just about bad credit and fixing credit. So anyway, we're going to move on here. So I love this slide here. Okay, home ownership and why? Why home ownership? Because it helps build wealth. Okay, not only does it plant roots and give stability, which is something I never had growing up. So this is kind of near and dear to my heart. It's just a statistical and historical fact. You guys don't have to take my word for it. This is not my opinion. So we've laid out an example here. Okay. So earning equity. So on a $200,000 home in this example here, right? Uh, you would have 100, and let's just say you had 50K in home equity or 150K mortgage, that would leave you $50,000 in home equity. Okay. So, sorry about that. Basically, whatever you don't owe on your home, what your home's value is minus its worth is your equity. So that's a simple example. Now I put over here I wanted to add a specific example for Wichita, Kansas, because that's where I'm located. So this actually is applied anywhere in Kansas. And I have this data source from the Kansas Housing and Market Forecast, but from Wichita State University. Okay. So on this example over here in my notes, you can see I said based on a 3% appreciation rate, meaning your home goes up in value yearly. Historically, home values increase and property real estate increases through time. So the value would increase on a 3% appreciation rate. That would mean in this example that it would increase 6,000 a year or 30,000 over 5 years. So that in combination with you paying your mortgage down over time, which we can give you a specific amortization chart to show you after so many years what you're going to chip away at. Yes, a lot of it goes to interest at first, but it's still better than paying rent. You're still making headway, plus you're getting the appreciation, and that's why it's so important. So, key note here. Okay, and this is based on Wichita. Forecasted right here for 2025 was 7.7%. And it's been much greater than that over the past years. In fact, It was even in the double digits not too long ago. Okay. So in the example of the 7.7 in 2025, that would actually mean you'd have about 77,000 in 5 years. That's just from living and owning a home, not to mention what you paid down on it. So it's very exciting stuff. Okay. Um, so you get predictable lower housing costs, of course. It's not controlled by the landlord. Even though rent might seem like it's cheaper, look at what it's costing you in wealth and overall, benefit for your life and to create generational wealth as well. Okay, so then we give some examples here of buying versus renting, freedom, equity, stability. So it goes over these examples. Landlord restrictions, maintenance depends on landlord, pets and guest limits. You're just under other people's rules. Yes, the mortgage companies have rules, but usually it's keep your homeowner's insurance, pay your taxes, which usually are escrowed, stuff like that. Your rent pays your landlord's mortgage. And so essentially you're paying a mortgage one way or not, one way or another. If you look at it like this, you're either paying your landlord's mortgage or you're paying your mortgage. Now you decide what's best. I do understand that there's times when renting may be the best option or the only option, but at least I encourage clients to get or potential clients to get the information so you can make an informed decision. I can't stress this enough. Do not go in and get dad's word or grandma's word or Uncle Bob or Tom, the coworker, whatever. There's a lot of information for mortgage lending, and it changes all the time. So even if they thought they knew what they're talking about, more times than not, they do not. We have to keep up with it, and I do this every day. So just get the data. I'm not trying to pressure anybody to buy a house, but get the data and then make an informed decision. And that is going to be the theme throughout this whole presentation. So in the spirit of getting data, stop paying your landlord's mortgage. You have a spot right here that you can do it on your own. If you get $1,000 a month in rent, do the math there. So 1,000 times 12, that's 12,000. Now do it times 2 years. Okay, that's 24,000. 3 years, that's 36,000. Whatever those numbers are for you, and then see what you're actually paying. And then you compare that to what we just did on the previous slide on the appreciation, and then maybe an amortization chart showing how much equity you could build, and you'll really start to be enlightened and see the difference on what kind of wealth you can build through real estate. And I'm not saying you have to be a home investor. You might just want to plant roots, but you're planting roots and you're building wealth, something to leave behind to whoever that is for you, whether it be your kids, your spouse, whatever, or charity, for whatever is important to you. It's better to have options and not need it than to have no options and need them. Okay. So the decision is made. You want to be a homeowner. What is next? All right. This doesn't have to be a super complicated process. This is actually a step by step, but I'm going to simplify this down. Okay. Really, you need to apply. You need to find somebody that you trust and apply. Get basically a workover or a free consultation. In most cases, people don't charge you for this. If they try and charge you for credit reports and stuff like that up front, that could be an issue. We don't do that. I'm happy to help anybody that's local or wants to reach out to me, but I also know that people have their own trusted advisors. So this is just kind of stepping you along the process, getting that initial application in, and then don't worry about credit. Don't worry about your income. Don't be A lot of times we're insecure about these things. I've felt this way myself. Okay. So get the information and get the help and get the knowledge. Even if you think you know and you've got a handle on it, I'll give this as a credit example. When we look at your credit, you might have good credit, right? But you might think, okay, I want to pay some stuff down to be completely ready. Well, we have things that we can pull for you that will show you how to get the highest score, paying the least amount of money down in the shortest amount of time possible. Okay, so instead of you just going off like randomly paying things off that you think is helping, which by the way, sometimes paying a credit card down to zero instead of $10 might cost you points. You might get less points paying it down to zero than you would paying it down to $10 or $100. It's crazy, but that is the algorithm and that is how it works, at least currently. And this is July of 2025. So keep these things in mind. Don't guess at it. Let us give you the information so you can be as effective as possible in whatever it is you're doing. Okay. Read through this in your own time. But, obviously we're here to answer your questions. Start here with the basics, credit, income, assets. That's basically all we're going to ask you. We're going to ask you for your date of birth, your social, your name, your job. I just want to get a snapshot so I can get the ball rolling and figure out where we're at. Okay. Then we'll dive into more specifics and what it pertains, what your goals are, what's important to you, how long you think you'll be in the home. Do you want to invest in the future? Do you want to keep this, or is it just a short-term option? There's a million different things, but you get the point. Okay. So credit. There's some things here. I got a little quiz for you real quick. Rent, utilities, credit cards, student loans, auto loans. Which one of these do you think is not included in your debt to income? There's actually two answers, okay? One is your rent. We're not going to count your rent against you. Now, we can use your rent to help you, as in a rental history that might establish some credibility or some rental history in the case where we don't always need that. But maybe if you don't have credit, if you have zero credit score, sometimes we can use that. We'll get to that later. Utilities. A lot of times, especially in this day and age, excuse me, people will include utilities as on their credit report, which is optional, in a way to build credit up. Okay. So, uh, we need to make sure that when we're looking at credit, and if you are going to have a mortgage professional look at your credit, that you make sure that they know that. Not everybody will look for it or catch it. I catch it just because I know to look for it. Okay. But there's a lot of lenders out there. I'm going to tap myself on the back and I don't care. Because I'm good at it. But, a lot of lenders will miss that and they will wrongly hit you with debt to income or payments that they don't have to hit you with. Your water bill, your electric bill, whatever you've added to your credit report, we can omit those from your overall debt to income. Now, with that being said, I have a little note here for you. We can actually help you set up utilities. We have a service where we will help you set up and shop for utilities. That same service, I can also show you how to shop your utilities or get estimated annual payments or what the costs are, excuse me. So if you really want to delve in and be really sharp and be informed so you can make wise decisions, we can help you figure out, hey, for this property you're looking at, guess what? It has an average $150 a month energy bill, or the water on average is $50 a month. You know what I mean? So these will vary depending on your usages, but it gives you an idea. The more information, the more informed you are, the more likely it is you'll make a wise decision. Okay. So credit cards, student loans, auto loans. I have another note here for you on student loans. One thing that is not a common knowledge is that when a student loan is deferred, okay, meaning it is not in repayment, people think we don't have to hit them with that payment, okay? But depending on the loan program, and there are still loan programs out there like VA, for example, if you qualify for a VA home loan, where you don't have to be hit with any payment as long as the loan is deferred for 12 months or greater from the closing date. So if you're supposed to close July 30th and it doesn't come due until August 1st of 2026 or whatever date, then we don't have to hit you with any payment. However, most cases, FHA conventional, we have to hit you with something. So I left you an example here in the notes. On FHA, we require a $10,000 student loan to be assigned at minimum a 0.5% payment or $50. I'll do the math for you, okay? So $50 is what I would have to assign to your debt to income. That doesn't mean you won't qualify. I just want you to be aware that there are things like that we'll have to do. It's just not because it's in deferment, we don't have to account it, okay? There are two types of credit scores, consumer credit and mortgage credit. Both range from the 400s to 800s. I'm not going to read from a script here. I can already tell you guys this happens all the time. The number one thing that happens, people prejudge their credit. That sounds, I hate saying it like that because it sounds to me like car salesy, but it's true. And the reason why they do that, it's not always their fault. It's because you have Credit Karma. You have all these different credit reporting services that aren't always going to line up with a mortgage report. So what you need to know is there's different scoring models. Okay. There might be an auto specific model, because consumer credit model, there's mortgage credit models. Okay. So these can actually generate and do generate different scores for the different bureaus. Okay, so that can mean a couple things. One, just because you pull a lower score, I might pull a higher score, or you might pull a higher score and I pull a lower score. Again, what's the theme? Get the information, visit with somebody, be in the know, and then we can guide you. I will never tell you no. Personally, you should find a lender that is not going to tell you no, but tell you I will give you a pathway on how to get there. It sounds so simple, but it's in some cases it's rare. So if you need help with this, you need a referral, you need guidance, please reach out. Um, no credit, okay? There is options for no credit loans, all right? So on a no credit loan, basically we can use what we call alternate credit. Alternate credit would be 12 months of a utility bill. That could be electric, that could be gas, that could be your homeowner's car insurance, excuse me, not homeowners, your car insurance. You get a letter from your agent saying, hey, Mr. Custer or Miss Smith has paid car insurance to Guild Mortgage for the last 12 months and pays on time. And it's got to be on letterhead, the official. The utility companies, the water companies, places like this will do the same thing for you. So just because you don't have a credit score doesn't mean you can't qualify. Just remember that, okay? All right, let me keep going here. So this is a little graph of what affects your credit score. Move this over. You pay attention to these five key factors. Amounts owed, of course. You want to try and keep these under about 30%, 35% usage rate. Remember what I said earlier, that paying down too much might actually hurt you at points. Now we're splitting hairs there. I'm just again in the spirit of get the information so you know exactly what to do. Okay. But you give a breakdown here, payment history. I think almost everybody's seen things like this, but 10% gets the new credit, 15% of linked credit, 10% of the mix, and 35% history. So a lot of weight is carried on what's owed and what your history is, of course. Okay. Credit issues, relax. You got this, and we can help you. I can help you guide you through this. So take control of your credit. Here's 7 tips for improving your credit score. One, we want to minimize the number of times your credit is checked. Now, key tip here, got a tip. A lot of times, lenders or agencies, mortgage agencies will tell you, or banks will say, after we pull your credit, don't let anybody else pull your credit, okay? Because it's going to hurt. It could hurt your score, or people think that it will hurt their score. But that is not the case. And do your own research. Anything I tell you, do your own research on, okay? You don't have to take my word for it. But the bureaus know that you are shopping for one of the biggest purchases probably of most consumers' lives, okay? So because of that, they will give you anywhere from a 2 week to 30-day period where you can have your credit pulled multiple times. Mortgage related inquiries, not credit card, automobile, and mortgage. No, if it is a similar inquiry, meaning mortgage related, then they won't deem your score again. So your score gets deemed once. So don't be fooled by people saying don't let your credit be pulled. Now, once you're set with a company, you don't want to, I recommend, my opinion, do not have a bunch of people pull it. Don't put too many cooks in the kitchen. It gets confusing. They'll confuse you. And anybody that jumps on the phone with you and says, well, I can beat that interest rate, or we can do better, right. And they don't even know anything about you yet. Hang up the phone. They are talking out of their butt. They don't know what they're doing. Anybody that's going to say that is in total sales mode. Okay. They don't even care about what your goals are, what your best interests are. They smell blood in the water, for lack of a better term. It's Shark Week, right? It actually is Shark Week right now at the time of this recording. So anyway, pay off all debts and past due balances. Now Most people aren't able to do this. So don't let that be a preventer in applying for a home loan or getting information so we can make a plan how to best set you up. Even if you need to wait, at least we can make a plan. That is a number one important. Okay. I made a little note here. Okay. Negotiate a settlement with any creditors. This is really important, guys. Make sure if you don't know how, reach out or look it up or whatever you need to do when you are going to negotiate or talk to creditors about paying stuff off, make sure that you ask them, if I can do this, if I could pay this $200 on this $1,000 balance, will you guys offer me a letter of deletion? If you don't ask, they won't give it to you in most cases. You have to ask. Why is that important? It's important because if you can get a negative item deleted off your credit versus just showing it being paid off, that will have usually a much greater impact positively to your score than just paying off a negative trade line or collection. Further, paying off a collection and just showing it paid sometimes can actually hurt your score initially because it's updating a negative item on your credit. These are the kinds of things you need to know and have walked through and understand before you just start digging into it. I've had phone calls with clients where they just say, this is my lender and I'm going to have him speak on my behalf and work through it just to give them an example of how to do it and how to conversate. It's not like a big hard negotiation. Excuse me. It's usually, hey, here's the situation. My client Joe wants to buy a house. He has a limited amount of funds for down payment and he wants to do the right thing and square up some of these accounts because it's going to help put him in the best possible situation to purchase a home. If he could pay down 25% of the balance or whatever of this account, would you guys be willing to give him a letter of deletion? In most cases, I'll get a yes. And if they say no, guess what? We move on to the next one so we can apply those funds in the best way possible. We want to use your funds and spread them out and get the most impact for what you have available. Okay. So keep that in mind. And I don't mind people being do it yourselfers. That's just one less thing for me to do, but you need to be aware that that's how there's a process to that. Okay. Pay your bills on time. That goes without saying. Fix any errors on your credit report. Now you'd be surprised how many people have errors on the report that aren't even justified and they don't even know it. So stay on top of it. You should review it annually. You can get free credit reports annually for free. In fact, it's required by law that they give you those so you can check it for accuracy. But that is something you have to do. They don't just send it to you. Okay. Definitely avoid large purchases on credit cards, and especially in the process of doing a home buying. If you think you're going to buy a home, don't go buy a new car. Buy your house, then buy the car if you can help it. I understand there's life happens, but that's another tip or things that happen or run up your credit cards, which will dip your score right before we pull you, which could get you a lower tier or maybe even prevent you from being approved at all. Okay. So, don't have a credit score. I've already touched on this. You've got options, rental payment history, utility payment record, auto insurance. We actually will help you with this. You don't need to be concerned with this. And this is a part of the process of getting informed and having a one-on-one. Okay. Income. Here's what lenders look for. 2-year work history. I'm going to touch on this briefly because I want you guys to know that you don't have to be at the same job for 2 years. Some lenders will tell you that. There's a lot of misinformation or they don't understand or they read the guideline and that's what they think. I basically just need to see that you've had a 2-year work history. And if you have had a large gap, I need a letter of explanation as to why. And there are certain things that could be applied. If it's been more than 6 months, well, you might have to be back at work for 6 months before I can even touch you. We'll get into that because each situation each situation is specific to each borrower because the loan programs vary and the guidelines vary depending on the loan program. Okay. So these are things that we are very broadly just giving you an idea. All right. But there's a few other examples, award letter, receipt of payments, award letter for Social Security, disability, Social Security. Now, I will say on child support, we have to usually show if you receive child support that it will continue for 36 months after close. So if your kid's 17 and it's going to expire in a year, I usually can't use that. But that's typically with FHA or even conventional programs. So if it lasts for 3 years, then I can consider it. Okay. Assets. Yeah, you can get down payment from a bank. So funds that we call these are source funds, meaning they've been in your account uh, from a gift. Okay. So this can be from a relative. For example, my dad wants to give me $10,000 for my down payment. Great. Stocks, bonds, anything like that, tax returns. These are things that we can use as assets or to use for funds for down payment funds. Okay. We not now keep in mind every lender is different. I'm of the school of thought that I try to ask for as little as possible. And then if I need, I want to know, but if I need it, I'll come back and I'll get it or I'll keep it in the file. I don't want to open up cans of worms and ask you for every single asset or statement of account or record, that you have that could open a can of worms or just be additional paperwork and headache for you to, you know, have to get when we may not need it. I just need to know where's the down payment coming from? Where did the earnest money come from? If we're using those accounts for the purchase. Sometimes we don't. Maybe we're using down payment assistance, stuff like that. Again, case by case basis, guys, but here's just a little slide for you to look at. You can never use cash. We can't use cash. And if you need to move cash around, and I'm not saying illegally, I'm saying you have money in, you're safe at the house, right? You have to deposit those funds into the bank. It has to be what we call seasoned in the account for a length period of time, depending on the loan program you're doing. And again, depending on the situation, we can discuss that. Bottom line, we just want to make sure you're not laundering money, the home, because laundering money through real estate is one of the number one ways criminally it is done. It's through real estate. So. Loan lingo. I'm not going to go through this. It gives you some terms here for you: appraisal, debt to income, earnest money, escrow, first time buyer, loan to value, mortgage insurance. This is all explained to the side. If you have questions, please let me know. It's just to help you kind of understand some things that are going on as we get through the process. It will be explained to you as I go along anyway. And popular loan program. We'll touch on this. So here on FHA, credit scores as low as a 540. I made a note here for you. What you want to know is that if you're under a 580 credit score, okay, we can go below a 580, but in any circumstances, the lower your score is, usually the more hoops you have to jump through. So we want your score to be as high as possible, not just because we don't want you to have to jump through more hoops than necessary, but because it will give you better terms and interest rates and options to put you in the best possible financial situation. However, we have options and we have to make sure you fit into these boxes and the requirements that are required when we are dealing with lower credit scores. The number one example, under 580 credit score, FHA loan, instead of 3.5% down, they'll say, hey, we'll consider your loan. And they also look at many other factors that I won't get into right now, but you are required to put 10% down. So, hey, if they got a little extra money to put down, we understand it's a little more risk. That'll offset that. We may move forward with them. Again, there's a lot more to it than that, but this is just a quick example. Conventional credit scores as low as 620 up to 97% loan to value. We can go over the pros and cons of conventional and FHA in a one-on-one because it is very specific to the borrower. And VA, okay, VA and USDA are the 100% financing loans. If you qualify, VA, you got to be typically a veteran who has a certificate of eligibility or a active duty military, sometimes a spouse of an active duty or deceased veteran can qualify, things like that. Again, it's specific to each borrower. USDA basically is just a rural development loan. So that just means if you go out on the outskirts of the area, like outside of from where I'm at, outside of Wichita. Now, some areas outside of Wichita are still not considered rural, but there is actually a USD eligibility map that you can just Google. I can help you get this information as well. But these things can be looked up. So if you have a specific property address, you can just look it up and it'll tell you if it's eligible or not. And then we can get into the details of the loan program later. Okay, dreaming of buying a home with 3% down payment, we have the loan for you. This is a conventional loan, guys. I'm not going to get into this. We just went over this. I want to get down to down payment assistance options and how we can navigate those things next because there's so many different ways we can do it. So you see, these are the required guideline down payments. Okay. Here we come into solutions. You need help with your down payment? You may qualify for down payment assistance. Everybody's situation differs. Okay. I'm going to give you some examples. Sometimes you have to be a first-time home buyer. Sometimes you don't have to be a first-time home buyer. Sometimes it's based on equity. I mean, not equity, excuse me, income. Meaning if you're below what we call AMI, which is average median income, which also, by the way, can be looked up. If you say AMI, that's Alpha, Mike, Igloo, AMI, lookup tool, Fannie or Freddie lookup tool. You put an address in, and for your area, it'll tell you, hey, 77,000 is less than 80% or whatever it is for your area, right? So why is that important? If you are under 80% AMI, you typically are going to get better incentives. Sometimes it's grants. It's not down payment assistance, and there is a difference. Down payment assistance usually is a loan, meaning we will, or it can carry a second mortgage. Not always, but they're, again, generalities, where you might have a payment of $50 or $80 or whatever for 10 years, and it's typically a 1% higher interest rate, but it's a means to an end. So that's down payment assistance. Grants, and usually the people that are under 80% AMI will fall into this category where you can get grant money. Okay. Which means money that does not have to be paid back. Very important. And I'm going to give a little plug here for myself and my company, Guild. We actually have programs that we create on our own. They're not government programs. So there's a lot of programs out there that are not even advertised. So speak with your mortgage lender in your local area. Make sure that there's nothing else out there that you may qualify for. And you don't have to be under 80%. Sometimes if you're between 80 and 100%. You can qualify, or if you're over 140%, you can qualify for something. It just usually diminishes. The amount you can get diminishes based on the amount of income you have. And there's all these different ways that we can mix and match and sometimes even stack the programs together. But you got to be so specific that we have to, keep it broad for this presentation. So again, one-on-one is where you're going to get this kind of data, which is important. So remember this: banking, gifts, stock market, any kind of assets, tax returns, things like that are acceptable. Down payment assistance, we just went through that. I wanted to make a note here that we have programs. You do not have to be a first-time home buyer. I just mentioned that, but because it says must be a first-time home buyer or not owned a home in the last 3 years. So I'll touch that on that. You can be considered a first-time home buyer if you have not owned a property in the last 3 years. Big tip for you. If you are a spouse who wasn't on the loan, but you were on title and they catch that, yeah, you're a first-time homeowner, or you're not a first-time homeowner, excuse me. That happened to me once, where the lady thought she was a first-time home buyer. Well, she was on title on her ex-husband's house, and she actually got a $30,000 payout to get removed from that title. So there was a little fraud going on there, but and we had to go to court over it, the whole thing, because she said that we lied to her about it being about her being a first-time home buyer. But really, she told us that she was not a first-time home buyer, and she even got a payout, knowing that she has an ownership associated to a property. So regardless, just know the main thing here is just to know that if you haven't owned a home in the last 3 years, you can be considered a first-time home buyer. But we have programs that do not require you to be a first-time home buyer, and we can still get you down payment assistance. Okay. Wanted to touch on this home buyer education course. These usually aren't too complicated, guys, but they also can be waived in some cases. So if you have a high enough credit score or your loan to value is low, they might not be required. But if it's required, we'll let you know. And usually there's no cost, or it's very minimal cost to get what they give you. Here's a couple of examples of some down payment options that we have, or some programs that we have here at Guild, where we'll let the client bring 1% down payment towards the 3% conventional amount. Then we'll contribute 2%, and you don't have to pay it back. And then on top of that, we'll also pay 1% of your interest rate for 1 year to help you make your mortgage payment more affordable with our payment advantage lender paid temporary buy down. So what we're doing, we're paying 2%. We're giving you 1%. So if the rates are 6.5, we're going to buy it down to 5.5% for the first year, get you in the home, let you get acclimated, kind of give you a little break, especially if you're starting off new, you know what I mean? And then on top of that, when rates drop with our payment protection, we'll refi you down without any lender fees. So we'll refinance when the rates drop. We don't have a crystal ball, but when it becomes an option for you to save money, not only will we refi you down, we'll refi you down with no lender fees, and we will typically monitor that because we service up to about 95% of the loans we originate. So it's good for us because we don't want to lose your business to a letter in the mailbox that you get from, ABC Mortgage saying, hey, we can get you a lower rate. We are proactive about alerting you so we can A, save you money, B, retain you as a client, and C, it's just great customer service. So this is just one example. We have a ton of programs. Closing costs 101. I'm not going to get into this all in the details because I want to go through this specifically with each client, but I made a note here to go over this. The number one thing you need to know about with closing costs that you need to remember before you do anything is what you have to bring to the table is entirely based upon the structure of your offer and your negotiation. So if your realtor doesn't know that you need the seller to pay $5,000 in closing costs, I'm just throwing out numbers, guys, and they don't ask for that, that means you need to bring that 5,000. Well, what if you don't have it? Then we have a problem. So point is this, it is very important for the lender and the realtor to be in concert and to have good, not just good, great communication with not just me and just not just the lender and their agent, but the client. It's a three-way. It's like a triangle. You got the lender, you got the agent, and you got the client. We have to all come together and have our communication say, hey, Miss Realtor, my client Bob has to get $6,000 in closing costs because he doesn't have any money and we're using down payment assistance. So the only way we can get a home for this client is to get this structure. And then it's their job to go out and get it. This can be done in a many ways. Sometimes they can just ask, excuse me, they can ask for it and the seller will give it to you. Obviously, that's ideal for our buyers, right? Or if the home will appraise and the seller isn't willing to pay it, well, maybe we can roll that 6,000 onto that $100,000 loan because it'll appraise for 106 at least. And then the seller will pay the 6,000 that way because it's not costing them anything. We're just moving numbers. This only works if the home will appraise. Again, it's ideal if we can get them just to pay it, but there are different mechanisms that we can use to help you guys with that. Just want to point that out. Okay, funds to close. Checking, savings, money, market, investment accounts, commingling of business and personal accounts, um, stock liquidation, 401k loans, proceeds from second line of credit, proceeds from the sale of another real estate. If you were selling a home, we can actually use the funds from that to apply, and I don't have to get a bank statement at all. We get a net seller statement, get it out again specifically, or a gift from close relatives. There is a specific way that all these different ways need to be handled as far as handling funds for down payment for the purpose of purchase of either primary residential real estate or investment properties. So speak with your lender on this, and we can guide you through that. So you don't have to have any more headache or create yourself more problems at work than you need. Need help with closing costs? We have solutions. We just went through this, but there's multiple programs. So these are examples of programs that we can use in conjunction a lot of times with other programs. Like we can stack these on. I'm going to leave these things for you to look at. Just gives you some options, 321 Home Plus, a little 3% down. You receive a 2,000 gift card, Home Depot plus up to 1,500 towards closing costs. And maybe there's something else we can do on top of that. Or maybe this isn't the best program for you. Again, very specific to the client and what's important to them or what they qualify for. Recap. Let's get started. You're invited to apply. Look, I am in the business to do home loans. I am local in Kansas, but we are nationwide. So if you need a referral out to another somebody that I know and I trust, I'm happy to do that for you. I can also help, kind of monitor some things, or at least give you a good send off, give you maybe a once over, things like that. But this is how I make a living and I support my family. So if you need help, the I would love the opportunity. And if you have somebody already, that's great too. I do ask that you guys share this with anybody that you think it might be helpful for, because there are a lot of things in here that just is not common knowledge. And that can help me in a way of getting the word out there, help me, reach the people that need this the most. And that is really my passion, because I did not have any of this stuff growing up. I didn't know any of it. And it's not stuff that is readily available, on how to purchase a home. It's not something they teach us in school. So let's apply for a pre-approval. Typically, you want your most recent pay stubs and most recent 2 years of W-2s. Now, it's great to have this stuff up front so we can vet it out and make sure that everything is, a-okay. But if you just need to pin it in to the application, if you do it online or whether you do it over the phone, just to get the ball rolling while you gather those documents, that's acceptable for me. Not everybody will do that. I like to give people the benefit of the doubt with them knowing, with the understanding that, look, this has not been verified yet. And my application or my pre-approval process is only as good as the information you give me. I think that goes without saying, excuse me. So we give you a little checklist here: application complete credit report poll. A lot of the stuff we do, it's just to give you an idea. Okay. That's the rundown. Loan program determined, down payment, closing costs, and monthly payment discussed. We're going to go over your budget with you. Hey, where are you wanting to be at? Sometimes people don't know what budget they want to be at, or they have some crazy number in mind, 500 a month, or they want to pay what they're paying in rent, but they don't want to buy a house that costs $500 a month. So there's things like that. But this is all stuff. This is why it's so important to talk. I know I keep saying it, but that's again the theme of this whole training is knowledge. I don't sound cliche, but knowledge is power. The more you know, the wiser decisions you're going to make, the less likely you're going to make a mistake, and save yourself a bunch of headache and brain damage and possible financially expensive mistakes. Stay pre-approved. Okay, we're almost done, guys. Stick with me, but this is really important. We do a TBD, which is to be determined loan, pre-approval process. Okay. I believe this to be one of the most beneficial tools that a client and a lender can utilize together. By knowing what you can afford upfront or what we need to do as far as credit, and moving you along that process with a very methodical, planned out, map basically, or blueprint, then when that opportunity comes or that home comes, because you never know, and it happens all the time. When an opportunity presents itself, you can capitalize on it right away, right? So I can't tell you how many times I've had clients, well, I'm not ready, or I'm going to pay some stuff off, or whatever the, ton of different excuses that we get. I don't care when you buy a home. I just want you to be ready. So when it comes up, you can pull the trigger. You got a pre-approval, boom, you're ready to go. Why is that important? It's important because while you're scrambling around trying to get your pre-approval, somebody else has already made an offer and stole your dream home away from you. Or you missed a great opportunity because you weren't prepared. Just like anything else in life, when we're prepared, we're ready to go, we have the advantage. Have the advantage. There's also some financial advantages that we can do for that. But not only that, you have less anxiety and stress because you know what you're doing and you're confident in what you're doing. All right. Find that perfect home. That's half the fun, right? When you have all this other stuff worked out, buying a home can be fun and should be an exciting process. It does not have to be stressful. Yes, it might cause some stress because you're in limbo, and I'm worried, is it going to go through or not? All this stuff should be a lead from this initial process. And if you're dealing with somebody who is reputable and knows what they're talking about, we'll help you find a real estate agent. By the way, I'm a lender, so I'm biased. But before you go out kicking tires and shopping for homes, shouldn't you know what you can afford first? Why do we have it backwards? We're going to the realtor first, before you even know what you can afford and what your budget is. Why do we do it that way? That's a flaw in the industry. Okay, guys. And I'll give you an example. If you're going to go buy a car and you're not approved yet, you don't have no idea what you can afford, and you go to a Mercedes lot, right? And then you find out, well, I can't afford a Mercedes. And then you go to the used car lot, figure out the car that you can afford, right? And this happens. How do you feel about that purchase? What do you feel sick or you feel let down? It's not the way it's supposed to be. Find out what you can afford now. Let's talk about how you can build wealth and plan and get that equity and appreciation that we talked about in the beginning to where you can eventually get your mega dream home or whatever as you evolve in your wealth building and things like that. Then let's go from there. But just for emotional, because we buy off emotion first, and then mentally later is when all that the buyer's remorse and stuff comes in. So that's what's going on. You buy with your emotions first, then mentally that stuff sets in later, and that's where buyer's remorse can come in. We don't want you to have that. So let's be smart. Let's be methodical. Get your finances in line first. Then go have fun and shop. Contract time, we'll get into that. Once you find a house and make an offer and it's accepted, you go under contract, we meet up with you, we get the ball rolling, we have you sign your initial paperwork, we lock in your interest rate, we get it through processing, underwriting, all this stuff will be explained as we roll through. Get a home appraisal, we get your loan commitment issued. Give you some tips here for smooth loan closing. Don't change job. We'll go through these. Don't change jobs or become self-employed. Don't change your job. If you become self-employed, all of a sudden you need 2 years of tax returns in most cases. So don't do that. Don't buy a car, truck, or van unless you plan to live in it. It's kind of funny, actually. It's the first time I read that. Don't let your credit card payments fall behind. Try not to get any 30-day lates while we're going through this, guys, because it can cause you a lot of issues, okay? And sometimes it can even blow up your loan. I've had that happen where somebody didn't make a payment on their house and it dipped their score. Now, it's not because we won't forget that or we won't say, okay, give me a letter of explanation. It's because when we had to rescore we had to refresh their credit report to reflect that it dropped their score below the minimum required to be approved. Just don't want you to have to deal with that. Okay. Don't spend the money that you've saved for your down payment. Don't let anyone else check your credit score. Uh-oh. Yeah, we just talked about that. See, and it's right here in our own thing. So within reason, it's a good rule of thumb. So just make sure you're not doing that. I want to touch back on the don't spend the money you've saved for your down payment and just add a little tip here. When you close on your home loan, guys, so let's say you close in August, usually you'll skip September. Your first payment won't be due even until October. So sometimes that'll allow you to recoup some funds, maybe from your rent payment or maybe your other house if you're selling it. So just something to know so you can budget better. Uh, don't make any large deposits other than your paycheck. If you need to do that, please talk to us first before you do it so you not have headaches, unnecessary headaches. Don't change bank accounts. Don't co-sign for anyone. Don't increase your balances on any credit cards if you can prevent it. If you need to do this or use them like normally, just talk to your lender because again, every situation is unique. We'll prepare for closing, get you ready for closing. We'll tell you how to read your closing disclosure. We'll tell you what you need to bring to closing, if anything, if you need to bring money to close. We'll go through all this through your process, but we'll initially issue a CD, which is a closing disclosure, and you have to sign no later than 3 days before you sign on your home. So if you miss this part here, if you don't do this piece, guess what? You can't close. So if we send it to you and you don't sign it, and 3 days has elapsed. So if I send it to you on Monday, that's 0. Tuesday's 1, Wednesday's 2, Thursday is 3. So if you sign it on Monday, you can't close until Thursday. Okay. So if you're supposed to close on Wednesday, that means we should have sent it to you the week before. We'll get you through that. This is more explanation on basically what I just explained to you. A closing disclosure example, which we can go through. And again, I want to go through this individually with clients, but this is for you to reference. Questions? If you have questions, this is my email, my cell phone. You can text me. You can look me up online. I also have a handle, the Home Loan Superman. As cheesy as that sounds, there's a story behind that. But you can use this QR code to find my link, find reviews online. If you guys need help, I would love to help you. If there's any questions, please let me know. And I appreciate you sticking this out with me and listening. And I hope it was helpful. Have a great day, guys.